Hello. In this video, I will share how to quickly develop an understanding of a business by looking at the one-page report prepared by Value Line. I will use Alphabet, commonly known as Google, as an example. But remember, it takes practice to get better at understanding businesses. And by practice, I mean you would have to look at and analyze several reports and businesses to improve in this area. And like anything, the more you practice, the better you get. So Value Line is an independent investment research and financial publishing firm based in USA. Value Line prepares regular reports for many publicly owned companies, and its reports are one of the best I've seen. They are sharp, focused, and to the point. But before looking at the Value Lines report, let me ask a question. How do you value a business to decide whether you can buy its shares or not? Now, there are various valuation methods, and in this video, I will just focus on the basics. Well, the first thing will be to not think of a business made up of shares. Rather, look at the entire business. Do not think of owning a few shares of that business, but think of owning the entire business as a potential business owner. This type of thinking will make you more inquisitive and cautious. So what does Value Line's one-page report tells us about a business? It provides a summary of the business. It tells you the market cap, number of shares outstanding, share price at the time of preparation of report, price to earning ratio, and some other relevant financial information which you can use to quickly understand the business. And this one-page report gives a very good snapshot of the financial situation of a business and has almost everything I need to see in 2 minutes to decide whether I need to look deeper into the business as a potential buy or discard it and move on to the next business. And most of these one-page reports are available for free from Value Line if you sign up. In other cases, Value Line might require you to pay a subscription fee to access these reports. And you can download these reports by going to the Value Line website, logging in, and then clicking on the PDF report link at the top right corner. Now the things I would look at are the market cap, revenue, operating margin, net income, debt, return on equity, return on capital, summary about the business, and PE ratio. And then I will try to make some sense of these numbers. So let's start. The market cap of Google is $1.4 trillion as of 30th September 2022. This tells me that this is one of the biggest companies in the entire world, maybe in the top 5 along with Amazon and Microsoft. Now, Alphabet or Google has 3 types of shares: Class A, Class B, and Class C shares. Class B shares are for the founders, and Class A and Class C shares are for regular investors. And this one-page Value Line report is for Class C shares with the ticker GOOG. The financials of the company will remain the same, whether it's Class C, Class B, or Class A shares. I don't pay much attention to the share price because it doesn't tell me anything about the finances of a business. So I tend to ignore the share price at the start. Now let's look at the revenue of Google. Revenue is over here. So just a note that for these numbers, let's say the revenue in 2021 is 257,637. What this means is that the actual revenue is 257.6 billion. So you just need to multiply this number with million and you will get the actual revenue. So the revenue in 2021 was 257.6 billion. So that's massive. And in 2020, it was 182.5 billion. In 2019, it was 161.8 billion. So I see that the revenue has been increasing year over year. So this is very good. Uh, Now, this means that the business is making money every year, and the sales are improving, or the sales are increasing year over year. Now let's look at the operating margin, which is just beneath the revenue. The operating margin in 2021 was 35%, in 2020 was 29.7%, and in 2019 again it was 29%. So by looking at this trend, you can see that the operating margin is late 20s, early 30s, 29, 29, 31%, 35% 2021, meaning the operating margin is very consistent. Now let's calculate the operating income quickly. So operating income will be operating margin multiplied by revenue. So let's do it for 2021. In 2021, the operating income was 35% multiplied by 257.6. It will give you approximately 90 billion. So the operating income in 2021 was $90 billion. Note that this one-page report prepared by Value Line does not account for depreciation when calculating operating income, but I'll include it because I want to consider depreciation. So after depreciation, the depreciation in 2021 was 11.55 billion. So that's the depreciation underneath operating margin. Deducting 11.55 from 90 billion gives us around 79 billion of operating income. Let's look at the working capital. The working capital in 2021 was 123.889 billion. You can also calculate the working capital by looking at the current position table, and it's just current assets minus current liabilities. So in this case it will be 188 billion minus 64.2 billion. It will give you the same 123.8 billion of working capital. So the reason I wanted to calculate operating income and I wanted to look at the working capital was to see how much operating income Google is generating from the deployed capital. So in this case, 124 billion of working capital or deployed capital is generating around 79 billions of operating income. So you can say that operating income is approximately 63% of deployed capital. So this is massive and very good. So this is not a bad business at all, because deployed capital is earning almost 63% in operating income. And if I look at the book value, I see that the book value is pretty clean and consists of tangibles including working capital. So this looks like a very good business and merits further investigation. Now let's look at the net income. The net income is this net profit. Over here, the net income in 2021 was 76 billion. 2020 it was 40 billion. 2019 it was 36 billion. So you can see that the net income is also increasing year over year. So that's pretty good. And looking at the net profit margin, which is also known as net income margin, the net profit margin is was 29.5% in 2021, 22.1% in 2020, 22.3% in 2019. This Value Line one-page report gives data starting from 2012 till 2023, so almost 10 years of data. So what we can see is that the net income is increasing year over year. The trend is that revenue is also increasing, operating income is also increasing, and the net income is also increasing. So this is very good. The net profit margin is hovering around 20%, 22%, which is really, really good. What this means is that for a $1 of sale or revenue, Google is earning 20 cents in profit. So that's pretty good. That's a pretty good business. Now let's look at return on capital and return on equity. What these tell me is that how efficient a company is in deploying its capital and shareholders' equity to grow the business. So return on capital in 2021 was 28.6%. In 2020 and 2019 was around 17% and 17%. So it's hovering around 17%, 18%, except for a big jump in 2021. So what this tells me is that for every dollar of capital invested in the business is returning 17 or 18 cents. So that's pretty good. Businesses that do well require little capital to generate money and profits. And this is the reason why I pay attention to return on capital. And return on shareholders' equity is 30.2% in 2021. It was 18.1% in 2020 and 17.9% in 2019. That's also pretty good. Obviously, there's a big jump in 2021. In fact, there's a big jump in 2021 for revenue, operating income, net income, and return on capital, return on shareholders' equity. To find out why there's a big jump in 2021, what I would do is I will read the financial statements, listen to investor relations call, and do some investigation. This is because I need to understand the reason of this huge jump in revenue in 2021 and whether that jump was a one-off or will the business continue to grow like this. Now let's look at debt. As for debt, Google doesn't really have much debt. Its long-term debt is 14.6 billion in 2021, or as of 30th September 2022. So that's nothing compared to the shareholders' equity of 251.6 billion in 2021. I will quickly calculate the debt to equity ratio just to see what it is. So 14 billion divided by 251.6 gives me 0.06. So debt to equity ratio is 0.06, which is nothing, which is very small. Normally, big companies carry a lot of debt on their balance sheet so they can grow their business. But Google does not, which is very good to know. This means that Google doesn't need debt to grow its business. And historically, I don't think Google has taken much debt to grow its business at all. So that's pretty good. Google is a well-known company. I mean, so I'll probably skip this business summary over here. But for other companies, I will pay attention to the business summary because it tells me a lot more about the business, gives me a good understanding about the business. So another thing I look at in the value line report is the PE ratio, which is mentioned over here, or the price to earning ratio. If the PE ratio is low and the business is doing great, like we have determined that the revenue is growing, net income is growing, returns are really good, profit margin is really good. What this means is that the share price is reasonable. But if the PE ratio is very high, such as PE is 50 or 100, then the business needs to grow significantly in future to justify its high PE ratio. And I'll discuss more about PE ratios in my future videos. And for most businesses, you need to check if they are able to pay their long-term debt and short-term liabilities. And for some businesses, you don't need to pay much attention to it. And for example, businesses like Apple and Google, because their balance sheet is so healthy, they carry small debts and they can pay off their short-term liabilities fairly easily. You can quickly check that they are more than able to pay off their debts. But for other businesses, you need to pay attention to whether they are able to pay off their long-term debts and whether they are able to pay to meet their short-term liabilities or not. And we will talk about these in the future videos when we analyze other companies. And those companies may not have healthy balance sheet like Google. Now that I have determined all this in a couple of minutes, I've looked at the revenue, I've looked at the operating income, net income, I've looked at the operating margin, net profit margin, and the returns. I can now spend more time on Google's business and look at its financial statements and listen to investor relations call to better inform myself whether I should buy this business or not. So this 2 minute of quick analysis from value line report tells me a lot about a business. For Google, in this case, it tells me that it's a really good business and needs some further investigation for me to make a decision about it. And in the next videos, I will look at the revenue composition of Google and its various businesses to understand where the revenue is coming from. It might be coming from Google Ads, YouTube, Pixel Phone, Google Cloud, Google AI, and others. And I will use financial statement for that. Then I will calculate intrinsic value of Google using discounted cash flow method to see whether the business is cheaper than the current price or not. You don't always need to do a DCF analysis. Most of the time, you can make a decision by reading financial statements and making sense of the numbers. But DCF is a good tool to learn, and in some cases, you may want to use it to make decisions. I will look at other businesses in my future videos and will go through their value line reports and financial reports to make it easy for you to understand how to value businesses. That's all for this video. Remember to be curious and be willing to ask questions and investigate. And if you have any questions, please include them in the comments. Thank you. Have a great day. Cheers.